My name is Alex Perney. I'm a certified IRA services professional here at Advanta IRA. I've been with Advanta since the beginning of 2012, so I have a lot of experience doing this as well as investments for clients and the business development side of things and education. So if you do have any questions, I've seen a lot of things and I've done a lot of different things with clients and associated strategies with Roth IRA specifically. So I'm happy to try to get some of that knowledge out to you today. So if you have those questions, feel free to ask them at any time. So a few key points that I'd like to make sure people take away today are what the accounts that you can self-direct. Now we're going to be focusing on Roth IRAs today, but there are other types of IRAs that you can self-direct. One of the uh, confusions regarding these types of accounts is that you have to have a Roth to do a certain type of investment, and that's just inherently not true. The function and purpose of Roth IRA conversions, so what exactly they are and how they function with regards to your taxable liabilities for a given year, and some strategies that are associated with them, because not just all else remaining equal, the act of doing a Roth conversion can certainly be easy enough to identify, but there are ways to help mitigate the amount of taxes that you will pay in a given year while still making sure that you get the amount of the conversion or the asset that you want to convert done within a timely manner as well. So a little bit about us. We have well over 20 years of combined industry experience. We utilize fully FDIC insured accounts to hold all of the cash for our clients. We have an account manager program, so you get a dedicated representative with us instead of just a different person each time. And I do need to update this slide. We have over $1 billion worth of assets for our clients held in administration right now. So that's something that we're proud of and helps to show the trust that people have in the service that we provide. So thank you for everyone, if you are a client, for helping us reach that milestone. And for anyone that is looking for some additional information, we serve our clients in Florida and Georgia. We have our corporate headquarters in Largo, Florida, and we also maintain an office in Atlanta, Georgia. So if you're local to either of those markets, feel free to make an in-office appointment, or you can always give us a call. Consultations are always free here at Advanta. A little bit of the history of the Roth IRA. The Roth IRA has not been around nearly as long as the traditional IRA. In 1974, the legislation for the Employment Retirement Income Security Act was passed, which created 401ks and traditional IRAs. And all up until 1997, the only way that you could contribute to a retirement plan such as that would be to have deductible contributions made to those plans, meaning that you would claim a deduction, so a reduction in the amount of income that you claimed in a given year, and then all of the earnings would grow tax deferred. So when you take a distribution, you are then in turn paying those taxes that you deferred on into the future. Well, in 1997, the legislation was passed for the tax-free growth of a Roth IRA to be established. Now, this allows you to take no deductions, so you're making after-tax contributions to the Roth IRA, and then paying no taxes in retirement when you take a qualified Roth distribution. And we'll hammer on this a little bit later, but a qualified Roth distribution means that the account and any applicable Roth conversions have aged for at least 5 years. You are of the age of 59 and a half as well, and then you can distribute the earnings tax penalty free. Now, another really cool aspect of Roth type accounts is that in 2001, the Roth feature was added to 401k accounts. Now, this is a really big deal because the Roth 401k has significantly higher contribution limits than a Roth IRA, so it allows individuals that are either covered by a Roth 401k employer plan or a solo 401k plan to make after-tax contributions and grow those funds tax-free and potentially at a much higher rate than they would if they were just utilizing a Roth IRA. So a Roth IRA is a type of personal retirement account that allows for non-deductible contributions of taxpayers' income. These funds then grow in the same tax-deferred manner as other IRAs, but the great thing about it is that once you take a distribution from a Roth IRA, you are paying zero taxes. So throughout the life cycle of any type of qualified retirement plan, whether it's a 401k, a traditional IRA, or a Roth IRA, none of the actual investments that you're doing. So if you buy a piece of property and sell that property, you're not paying any taxes on that sale, any appreciable gain in that sale, if you are utilizing a traditional or a Roth IRA. We got a question. Okay, we got a question here. Let's just expand that a little bit. Okay, Greg, I'm hearing more about using an inherited IRA as an investment and wealth building strategy. I don't believe that this is the traditional sense of passing someone's remaining balance to a beneficiary, but rather a wealth building strategy. So there is certainly some strategy to that. Now, inherited IRAs are going to be a little bit of a different animal than just a IRA when you talk about it in your traditional sense of saying, hey, I have a Roth or traditional IRA. And an inherited IRA is something that you inherit from someone that has died. Now, when you inherit an IRA, there are some different rules that are going to be applied to that type of IRA. If you're the spouse of the individual that died, you can treat it as your own IRA and it just gets lumped into your other IRA retirement accounts. If you are a non-spousal beneficiary, so a child, a grandchild, a niece, nephew, anyone other than the spouse of that beneficiary, you can inherit that account. And the nice thing is with IRAs is they're exempted from the probate process and you don't have to pay estate taxes on those in states that might have them. So it exempts itself from probate and then passes that on to your inheritors after your death. Now, there's different ways to do that. You can have it structured where a trust, maybe a non-revocable on death trust inherits the IRA, and then you have the trustee delineate out the distributions to the applicable beneficiaries of that trust. But the one caveat to a beneficiary IRA is something that is not used when you have a present day IRA, so let's say a Roth IRA, and specific to this, a Roth IRA, once you reach the age of 70 and one half, does not have a required minimum distribution, whereas a Roth beneficiary IRA does. Now, those distributions to the beneficiaries are going to be tax-free, so that certainly is one method of wealth building for family planning purposes or estate planning services purposes, well, mixing those up, that can be very beneficial. So you can create tax-free revenue streams for your beneficiaries later on in life that they didn't have to pay inheritance tax on and that were exempted from probate. So the inherited IRA is great, but it's not something you can do presently while you're still alive. It's something more to the fact of estate planning purposes that people utilize those types of strategies. But great question, Greg, and it's certainly something that has a lot of answers and a lot of different strategies associated with it. So how do you get money into a Roth IRA? Well, there's three primary ways you can do it. If you want to self-direct your Roth IRA, all you have to do is just move it from one IRA custodian to the other. We submit a transfer request to your current custodian, whether that be someone like Charles Schwab or Fidelity or Raymond James, and you just move the funds directly into an IRA that you have here, and then you have a new Roth IRA ready to go to self-direct. You can also do it via a direct rollover. Now, if you have a Roth 401k plan, this is the method that you have to do. And I like to distinguish between a rollover and a transfer because they inherently are they are very different in their tax reporting in their tax reporting actions that they do. So with a direct transfer, where we submit a transfer request to a custodian and pull the funds over to our platform, there is zero tax reporting. Now, people erroneously at times will say, hey, I'm doing a rollover. Well, a rollover is a type of distribution. The distributing type of account issues a Form 1099-R, indicating that funds were withdrawn from that plan. 401ks, if you do a rollover from an IRA and you have a distribution issued, then you're going to have a 1099 floating out there. And if the receiving custodian is not aware or has submitted paperwork in a different manner, then the applicable IRS Form 5498 may not be filed, indicating that it is a non-taxable movement. Although this is kind of a technical detail, I'd just like to make sure people are aware that the rollover really is specific, should really be reserved just for your 401k and employer type plans that you're rolling over, and a transfer is really the ideal method to utilize for any type of existing IRA. I've seen clients have this kind of mixed up before and did the paperwork wrong, requested that we process a transfer, the resigning custodian processed it as a rollover, and then they were unaware that the IRS thinks that they have a significant tax bill that they need to pay. So I just like to make sure it's out there, understand what you're doing and what particular reporting might be done in association with those types of movements. Now, I indicated that there are many different types of plans. We're going to be focusing on the Roth IRA, but something I like people to understand, and the reason I leave this slide in this presentation, is that some people think that you only can utilize a Roth IRA for certain types of investments. I've had people say, hey, I'd love to buy that piece of real estate, or I'd love to make this loan out of my IRA, but I don't have a Roth IRA. I only have a certain type of plan, maybe it's a SEP IRA or a traditional IRA, and I can't do that. Okay, Ed asks, good question. If a person makes currently around $500,000 in retirement, his income will be Ed, I'm not sure exactly what the question is. If a person makes currently around 500K in retirement, his income will be around 550,000. If you could clarify, are you asking with regards to making contributions to a Roth with the applicable phase outs of the contributions? Just get back to me on that question and I'll be happy to elaborate. So, let's see, we might have some clarification on that. So, is it advisable to transfer to do a conversion of a traditional IRA to a Roth IRA? Well, that's going to depend a lot on your personal taxable situation. With higher wage earners, such as someone making 500,000, you might have losses or other large deductions that can carry forward to help offset the tax liability that's going to be associated with a Roth conversion. Because with a Roth conversion, when you take money from a traditional type plan, whether that be a 401k or an existing traditional IRA, and move it into a Roth IRA, you have to claim that amount or the value of that movement of cash or assets as additional taxable income for that given year. So if you do have high wages, you might be paying in higher tax brackets, but depending on where that income is generated, whether that's from passive or active sources, whether that's W-2 qualifying income, or whether that's maybe some type of capital gain that you're realizing, having a Roth conversion happen can certainly be something that's it will increase your taxable liability for that year, but it might be a little bit easier to offset since you do have higher wages that you're earning. Ultimately, at the end of the day, whether or not a certain person's level of income is advisable for them to do a Roth conversion to get money into a Roth is something that needs to be run by a qualified tax professional, such as a tax advisor, a tax attorney, or a CPA, to make sure that it's a good fit for that individual or household to be doing that type of movement of cash, as there is a taxable event that is incurred with that. Great question. So I like to leave this slide up here to make sure people understand that no matter what type of account that you have, you can self-direct it. It doesn't have to just be a Roth plan that you're utilizing for self-direction. And another reason is that I want people to understand which types of accounts can be converted into a Roth IRA. SEP IRAs, traditional IRAs, and individual 401k plans, or 401k plans in general, funds from those buckets can be converted into a Roth. Education savings accounts, health savings accounts cannot be converted into Roths. They have to remain outside of that. All the health savings accounts, and I taught a class on this last week, do have some very interesting aspects to them if you qualify with a high deductible healthcare plan to allow you to make tax-free distributions just as in a Roth. So there are some inherent strategies with some of these other accounts to get tax-free distributions, but just understand that there are only certain types of accounts that can be converted. They are the SEP, individual 401k plan, simple IRA, and traditional IRA are the types of plans that you can move cash or assets actively from and into a Roth and then create a larger Roth basis for tax-free earnings and distributions later in life. So plan contribution limits, I do apologize, the comma is in the wrong place for the traditional and Roth IRA presently. The traditional IRA contribution and Roth IRA contribution, meaning the amount of money you can take out of your own pocket, your earned income in a given year, and put into a plan is going to be $6,000 for individuals under the age of 50 and a half. And if you're over the age of 50 and a half, you have an additional $1,000 catch up that you can make. SEP IRA contributions are $55,000 or 25% of your compensation, which is another interesting aspect to look at. If you're looking for something to make larger contributions to a plan to allow you to do a Roth conversion, the ability of yourself to contribute up to $55,000 a year of your compensation into a plan and then convert it can be maintained with the SEP IRA. The simple IRA has a little bit of a different methodology to it of contributing into that plan, but you can also convert those funds. And the cool thing about a solo 401k and the Roth conversion strategies associated with them is that you can make your $18,500 salary deferral contribution into that plan non-deductible, so you can do it as after tax. And then the 25% employer match, you are always going to make as a tax deferred contribution to that plan. And then at the end of the year, you can determine if you want to convert all or a portion of that additional 25% or up to $35,000 into the Roth portion of that plan. So you have some room to make that determination. Now, keep in mind that that is going to be a taxable event to you in the amount of the funds that you convert in that plan, but you are allowed to convert the entirety of the $60,000 max of the 401k contribution into a Roth account per year, as well as making your Roth IRA contributions as well. So you do have quite the ability to make a very large amount of contributions depending on your income and your earnings in a given year into a Roth IRA. Just enumerated that slide again. Now, it's important to understand that there are some types of accounts that you can, or there's some assets that you cannot purchase within an IRA, a Roth IRA, or any type of retirement plan. It looks like we have the 2019 contribution figures, Robert, are going to be $6,000 for individuals under the age of 50 and a half and $7,000 for the individuals over the age of 50 and a half. The contribution limits for SEP IRAs are 25% of your gross income up to $55,000, and 401ks are going to be $18,500 of earned income, and then an additional employer match of up to $35,000 or 25% of net operating income. So prohibited transactions. It's very important to understand what you can and cannot invest with once you've utilized a self-directed IRA. So you cannot buy a life insurance policy, and you cannot buy anything that derives its value from collectability, such as antiques, alcohol, artwork, stamps. You can buy some types of gold coins or silver, platinum, or palladium coins that are issued by state agencies such as the United States, Mexico, Canada, Australia, China, that are sold on their bullion content value, but nothing that is essentially rare or collectible in nature. And there are certain people that you cannot directly deal with. You cannot deal directly with your spouse or yourself personally, so you can't buy or sell an asset to or from yourself or your husband or wife, any of your children, or your parents. Now, this does not include brothers or sisters. So if you have a deal that you would like to do potentially with your Roth IRA and your brother or sister, that is absolutely fine. So we're going to start getting into a little bit more of the specifics on considerations for Roth IRAs. One of the big benefits is that you have tax-free earnings and no taxes on the withdrawals when you make a qualified distribution. Now, a qualified distribution, again, and this is very important to remember, is that the earnings on your Roth IRA contributions cannot be distributed tax and penalty free until you have had the account open for at least 5 years. And that 5 years is a year from the year in which you establish the account. So if you establish your account in December 31st of this year, you get credit for the entirety of the year for having the account open. And the nice thing is that the contributions to these plans, to a Roth IRA, so if you put your $6,000 or $7,000 in there on an annual basis, you are always able to access those contributions tax and penalty free. And the Roth conversions can always be distributed tax and penalty free once the account's been open for 5 years as well, because then those are considered basis in the account. So you have no required minimum distributions with these accounts as well. It looks like we have a question. We have someone asking, does account open mean funded as well or just opened? You need to fund the account. So, and that doesn't have to be anything inherently large. You can fund it with $1, but open and fund the account in that year. But you do have to have the account funded. I've seen people run into that issue with not funding the account. Now, a big thing that people have to realize with traditional IRAs is that once you reach the age of 70 and a half, you have what are called required minimum distributions, meaning that you have to take out a certain amount out of that account per year based on your life expectancy and whether or not you are married. Now, this is also a downside to that account because if you have illiquid assets, let's say you have several $100,000 worth of real estate, but not much cash on hand, then you kind of run into an issue with, well, how do I take the distribution? Well, unless you have funds in another traditional type account, then you are going to be you're going to be in a pretty tough place because then you might have to distribute a portion of the properties or distribute an entire property, which would maybe far exceed the amount of your required minimum distribution. And you can no longer make your contributions to a traditional IRA after the age of 70 and a half. The nice thing about a Roth IRA is that you have 0 required minimum distributions and you can continue to make contributions into the plan so long as you have earned income well past your 70 and a half birthday. Oh, got some good questions. Does a Roth 401k have required minimum distributions? That is a very interesting question because the answer is yes. Unlike with a Roth IRA, a Roth 401k, it does not matter, does have required minimum distributions. Now, the interesting thing about a Roth 401k, let's say you still have plenty of income to qualify you making contributions into a Roth 401k and you still want to make those higher contribution limits, you can make the contribution and then immediately roll it out to a Roth IRA because the required minimum distribution figures are going to be factored in on a year-end value of that 401k. So if you can make the contributions in a given year and then roll them out to a Roth IRA, your year-end figures can be significantly reduced for the Roth 401k and not have to take a significant or any distribution from that account. Pete asked, does a 403b account allow me to convert to a Roth IRA? It's going to depend on a few aspects of that. Now, 403b plans do have Roth provisions if the employer allows for it. So if your employer allows for a 403b Roth contribution or after tax contribution, then you can just do it there. Now, if you have severed employment with the 403b plan sponsor, then you can certainly roll those funds directly into a Roth IRA via a conversion and pay the taxes on the amount that you have converted over. The only real kind of thing that a sticking point that I would bring to your attention is that if you're still currently employed by the 403b administrator, if you're a common law employee or let's say work over 1,000 hours a year, then you're probably not going to be able to roll the funds out of that plan and therefore cannot do a Roth conversion. But if you've severed employment or you're of the age of 59 and a half or older, you can probably access those funds and then do a Roth conversion with them if you'd like to. So one other big benefit of Roth conversions or contributing to a Roth IRA is the presence of lower taxes in present day. So one trend, and you can look at it pegged for inflation and a bunch of other factors, but if you go back over historical period of time, taxes have always risen. We've never seen taxes kind of fall off a cliff and say, oh, well, if I had only waited, another 20 years, taxes would be lower. Inherently, taxes always have a tendency to rise. So being able to take advantage of the present day taxes and the present day inflationary rate does give an advantage to utilizing a Roth contribution of paying the taxes now or a Roth conversion of paying the taxes on a large sum of money or assets in order to get them into a tax-free growth vessel so that way you don't have to worry about the increase in taxable rates in the future. Looks like we have another question. Good question, Karen. So she asked, for the 5-year waiting period, does that apply if it was a transfer from another custodian? No, it does not. So you are responsible for tracking your 5-year period. So if you have opened an account at another custodian, let's say you've had a Roth IRA at Fidelity for 10 years, and you decide to self-direct and transfer it over to Advanta, then you would not have to restart that clock. It's from the continual date of having an account open. So you could even close that older account, but so long as that you open an account and have it, so long as you had continually had a Roth IRA for the entirety of that 5-year period, that's what they're looking for. Ed asked, Roth IRA, can Okay, I believe I know what you're asking. So I believe what Ed is asking is that can you withdraw the basis of the account? Yes. So if you have made contributions to a Roth IRA, you are allowed to withdraw those contributions at any time, tax and penalty free. You don't have to wait 5 years. You don't have to wait till you're 59 and a half. And I tell this to a lot of my younger friends is that start a Roth IRA, and if you have children, tell this to them too. Even if you are a little bit tighter on cash and don't have as much flexible income to contribute to retirement plans because of the restrictions on distributing them, especially with, let's say, a traditional IRA, or even if you've made an earned income contribution to that plan of $6,000 or $7,000 in that given year, you cannot take a distribution of that without paying a 10% excise tax penalty and then taxes on it. So with a Roth IRA, if I put $6,000 into that plan for 3 years and I have $18,000 of basis and let's say $3,000 of earnings, I can always touch that 18,000 as if it were just my own personal money market. There's no tax or penalty associated with taking those funds out. Now, when you distribute from a Roth IRA, you always distribute in layers. When you take a distribution from a Roth IRA, the first thing to be depleted is your contributions. So if you had, let's say, needed to take out a $10,000 distribution and you had that same example I gave of $18,000 of contributions, there would be zero taxes and zero penalties associated with that. But then keep in mind, then you only have $8,000 more of basis in that account. And then if you had that $5,000 of earnings, so you had a total in that account of 18,000 of contributions and then $23,000 of total cash, you would only then have another $8,000 to work with of your contributions to that plan, and you were responsible for tracking that basis. So if you had then in turn taken another $8,000 distribution, but the account had grown and was now worth $30,000, you had a lot of earnings in there, you would have to wait until you were 59 and a half and the account had been open for 5 years to take a tax-free distribution of those earnings. All right, Robert asks, can one convert a Roth 401k into an IRA? Are there disadvantages to this? Well, you don't necessarily convert a Roth 401k into a Roth IRA. You would just do a rollover. You wouldn't have to consider any additional taxable implication. If you already had a Roth 401k, you essentially would just be transferring it, or you would be rolling it over into a different style of account. Now, there are actually some advantages to this and maybe some perceived disadvantages. One advantage of rolling a Roth 401k to a Roth IRA, depending on your age, is that you have no required minimum distributions from a Roth IRA. So let's say you're of the age of 70 and a half, and now you have 401k required minimum distributions for that Roth 401k. Rolling out those funds in that plan to a Roth IRA will mitigate having to do that. Now, one disadvantage of rolling a Roth 401k to a Roth IRA, and let's say you were to close that plan, is the fact that the Roth IRA has much lower contribution limits than a Roth 401k. So disadvantages, yes, but it really is only in the aspect of the ability of one to contribute monies. There are some additional advantages with a 401k that I won't get into. They kind of have to do with asset structures and different things, but I wouldn't say that there's necessarily a disadvantage to this. If anything, there might be some advantages to it, depending on your age. The contributions being able to be made far into the future, access to the contributions without penalty, And the 5-year waiting period, I think we've covered everything here. Looks like we have another question. Oh, my pleasure. Would advance the slide. Oops. Roth IRA, so we'll go over this a little bit more in detail because it is very important. You have to be 59 and a half to get fully qualified distributions. Remember, that is the earnings of the Roth IRA. So anything that has been earned on any of the conversions or the contributions has to be 59 and a half in 5 years to get the tax-free distribution. Now, if you do a Roth conversion, meaning that you are moving funds from a traditional type account, so that is going to be a SEP IRA, a traditional retirement plan such as a 403B, 457, TSP, 401k, a traditional IRA, any of those things that you convert into a Roth IRA, you assess at ordinary income rates. There's no special metric to use for factoring your taxable liability for a Roth IRA conversion. So when you do a conversion, you will be receiving IRS Form 1099-R, and then when you file your 1040, your modified adjusted gross income at the end of the year is just increased by the amount of that conversion. So you don't have to necessarily worry about it being taxed at a different rate, like trust rates or anything else like that. It's whatever your current tax bracket is what it's going to be taxed at. And the one big advantage to this is, let's say you have a loss or a large amount of deductions to take in a given year that you can claim personally, that can help significantly offset any taxes that you might be paying on a Roth IRA. Now, all contributions must be made in the form of cash and from taxable earned income. You cannot utilize passive income such as interest or anything that you have not paid Social Security or had minimum withholding taken out of. You cannot utilize that for a Roth IRA contribution. Now, again, that has nothing to do with conversions. That's just for the $6,000 or $7,000 that you're adding in on a given year, has to be made from earned income. So typically it's going to be filed on Schedule C of your return. So whatever is on that schedule, you can use to factor in how much of a contribution you can make. And ordering, this is very important, especially for people that are concerned about the access to the funds they have within an IRA. Contributions are distributed first. So tax and penalty free, always first. Imagine kind of like shooting a target of three pieces of paper with an arrow. The first piece of paper that it hits is going to be your contributions. The next piece of paper it's going to hit is going to be the converted amounts. So anything that you've converted, that next bucket is going to be hit by that arrow. And the last thing that it's going to hit are going to be the earnings. Now, this can be easy or complicated depending on if you ever take distributions from an account, because you have to make sure that you track this over the life cycle of the account. If you've been making contributions and having earnings and done some conversions over the given years, and you've also been taking distributions, it is your responsibility to track how much of each one of those buckets is there in order to make sure that you are either paying taxes or it is a tax-free distribution for the purposes of filing your taxes. Ooh, I needed to change this to 2019 on this slide, but the limits only went up by $1,000. So you can't always make a contribution to a given Roth IRA. Now, this can be alleviated by doing a Roth conversion because there is no income limit on doing Roth conversions. So if you want to make your $6,000 or $7,000 contribution, the individual phase out, so the ability for you to make a contribution, and keep in mind that this is a pro rata phase out, meaning that if you make $120,000, you can, as an individual, you can make the full $7,000 contribution or $6,000 contribution, but it's a pro rata phase out up to 135. Now, if you're married filing jointly, it's 190,000 to 200,000. And if you are married filing separately, it is going to be a $10,000 annual limit on your income. Now, keep in mind that is just for the limitation of making a contribution directly to the Roth IRA. People like to refer to the backdoor Roth IRA contribution as making your traditional IRA contribution, because you're never you're never phased out of that. Your ability to make a traditional IRA contribution is never reduced by the amount of money you you make in a given year. So you can always make a contribution, and then since there's no income limitation on conversions, you then can turn around and immediately convert that amount as well. So one thing people like to espouse on, and it's by no fault of the individual, is that politics can, let's say, be a bit divisive at times, with regard to especially taxation and where people are going to be targeting in any given administration or legislative session as to where they're going to get funds from. Now, the benefit of the individual to have tax-free growth and tax-free distributions is fantastic, but a lot of people like to paint this as a target or say that a particular legislator or that the IRS is going to shut these down. Now, some people do espouse this, and I believe it to be a bit of a red herring, and I'll kind of break it down for you and why I personally believe that the Roth IRA is not going anywhere. And the main focus of this is that it's the present value to the IRS and essentially the coffers of the United States to make sure that they are receiving present funds. When you have deductions that people are claiming and you have tax deferred growth, the government is not making any money off that in the present day. They're having to carry that forward as a potential revenue on their books. They're not actually making anything presently on that. So I'll kind of go through this so if anyone that's not looking at this can kind of get it through their speakers. So the effective traditional IRA contributions. 100 individuals all make a $5,000 contribution to a traditional IRA, resulting in $500,000 worth of tax deductions. If the taxpayer's average tax rate is 20%, this results in $100,000 less in tax revenue that the government receives. Multiply that by the actual number of individuals making the contributions. Down the line, the IRS government will receive revenue on the distributions. But now they have to effectively think that, one, this person is going to make distributions, and two, when they do, they can't control necessarily how much, and then that's why they have the required minimum distribution to force them into doing that. Another aspect of this to look at is that if the individual dies, and they are 70 and they die, they've never taken a distribution, so they've gotten deductions for all their contributions, and then they haven't paid any taxes on the earnings, and then they die, then the beneficiaries will base their distributions on their joint life expectancy tables, which could then put that amount of funds and taxable income that they are getting well far out into the future if they're very young, if they receive that account. So the government is making inherently a lot less money in the present day with a traditional IRA. Now, the effect of Roth IRA contributions in the same example is that 100 individuals make $5,000 contributions to Roth IRAs. Without deductions, $100,000 more in taxable revenue is received by the IRS presently. No tax revenue in the future, and for this reason, that's why I don't see them being eliminated. So in one scenario, you have the government receiving $100,000 less in taxable revenue, and then in the other scenario, you have $100,000 more. So that's why I like the Roth IRA, and as much as people may like to posture in the government and say that these things are going away or they're going to be low-hanging fruit and targets, I don't really see that happening, just for the simple fact that when it comes down to the people that are really looking at the numbers and people that work for the IRS, I think they can see that this does make a good amount of money in the present day. And obviously, the government needs money presently to work. They can't all be deferring it and kicking it down to the future. All right, so conversions defined. So with a Roth IRA conversion, you're going to be taking funds from a traditional type of account, such as we've discussed, such as a 401k, a traditional IRA, or the like, and moving it into a Roth IRA. So in the most basic terms, that's going to be taking a pre-tax account and moving it into a post-tax account. Then you are likely to pay the taxes in the present as opposed to in the future, and continuing to have them grow tax deferred. Going forward, then the funds grow tax-free and are eventually distributed tax-free as well. Although this is a bit of a repetition of what I've said in this, it is important to remember the exact mechanism is that when you're talking about a conversion specifically with regard to a Roth IRA or 401k, all you're doing is taking tax deferred funds and moving it into a tax exempt fund type of account. Now, prior to 2010, the taxpayer needed to have a modified adjusted gross income of less than $100,000 in order to perform a Roth conversion, and they could not be married and file separately. Presently, so from 2010 on, you are able to do a Roth conversion with irregard to how much money you make as a joint married filed couple, an individual, or a separately filing married couple. So that's really important for people, especially when you're looking at doing Roth conversions of large assets, such as a piece of real estate, and it allows you to strategize very well with regards to your estate planning and a lot of different things when it comes to looking at how much taxes that you'd like to pay on the funds that you have earned over your lifetime. Now, here's where the really big strategies kind of come into this, is that when you're looking to do a Roth conversion, keep in mind that you have to do it by December 31st. There's no such thing as a previous year Roth conversion. So even though you have the ability to make a contribution up until the 15th or your filing or the timely filing deadline for Roth traditional IRAs, you have to perform that conversion by the end of the year. And the amount of that conversion is included in your personal taxable income. And you can offset this with losses. Now, the reason I like to bring up the end of the year is that you have a deadline for that. So the nice thing is when you're looking at a Roth conversion, let's say you have a piece of property that's worth $100,000, or $100,000, but you don't necessarily want to realize $100,000 of additional income in that given year. So what you can do is that, and we do this a lot, and this is why it's one of the reasons the end of the year is very busy for us, is that an individual will get an appraisal of the property the last date of the last week in the year. We will do a conversion of half the property the last week in December, and then the following week after the 1st of January, we'll do a conversion of the other amount, thereby splitting their taxable liability across 2 different years, but accomplishing the entirety of the Roth conversion within a single, within several days. So you get the whole asset converted, but you get to split the liability across 2 years. Now, for direct tangible assets, this is very easy to look at. You get an appraisal of the entire amount. Whatever portion that you convert in a given year is how much, divide that by the number, and that's what you get. It gets to be a lot more creative when you look at things like LLCs and trusts, or businesses or shares of companies that you may hold. Now, with things like common stock, Microsoft, IBM, things like that, this strategy doesn't really apply. But if you're looking at something like the beneficial interests in a trust, or more specifically, maybe membership in an LLC, there's discounts that can be taken for the amount of conversion that you're doing. Now, this works very well with LLCs, and this is kind of a carryover from estate planning purposes of how much value is being received in a certain decedent's estate by different individuals. So it is relatively common, and again, we are not tax advisors. We're not giving tax advice in this sense. If you are going to do this, you do need to have a qualified third party perform the valuation that is familiar with discount valuations of controlling interest. But the basic principle is this: is that if someone were to buy 49% of a company, that 49% is not a controlling interest in that company. So if an IRA owns an LLC 100% and you value it at $100,000 and you want to convert 49% of it, well, that 49% is not really necessarily worth $49,000. There is inherent value to a controlling interest of an entity. So that $49,000 representing 49% of the company, or maybe less, can be discounted by a certain percent, and that's going to have a lot to do with the actions of the company and the valuator's opinion. So that's why you do need to have a qualified individual, such as an attorney or a CPA, do this valuation. But there's also strategies if you hold things within IRA-owned LLCs to discount it further, let's say at the end of a year, and then convert the controlling interest in the following year, thereby allowing you to split the liability across 2 years and pay potentially less taxes on the front end if you're converting the minority interest in a certain given year. This same type of strategy can be applied to trust and beneficial interest, but it's not as common. So LLCs are certainly one way to do that. And some people will even go as far as to form a new LLC. The IRA will own it. They'll contribute the property as the capital contribution into that LLC. So they'll essentially create a checkbook control IRA if they didn't have one before, and then utilize that conversion method to help reduce and mitigate their taxable liability across multiple years. Again, this is definitely a more advanced method for spreading your liability out and potentially discounting the amount of conversion taxes that you have to pay. So get with someone that's familiar with it. We have referrals of people that can help you with valuations and the like, but it's important to remember that because you have a hard deadline for a Roth conversion, you are able to split the liability across 2 different years, greatly reducing the amount of taxes you might have to pay in any one given year, especially if you have maybe losses that need to be used, if you have large deductions in a given year. It's not an all or nothing thing with a Roth conversion. It's important to remember that you can do smaller portions. You can do smaller portions or do little bits at a time to help try to whittle away at the amount that you're going to have to the amount of taxes that you're going to have to pay. So why and when convert to a Roth IRA? If you're expecting large returns on an investment in the future, this is commonly done with people that are buying into startups or are doing things where they have a potential to have a very high amount of earnings in the future. So they want to reduce the amount of taxes that they pay. And since things like private stock or investments into startup companies are inherently valued more or less at par value, a lot of the times they will value the asset and then convert it or do it directly through a Roth IRA to begin with to help try to drive off that taxable liability. If your current IRA contributions are non-deductible, so those same income limitations that I went through earlier, so 190 to 200,000, if you're not making your IRA contributions as deductible, you're phased out of that, go ahead and do it into a Roth IRA. You can convert the contributions over into a Roth IRA. You're still not going to be getting a deduction for it, so you might as well just do it in there. You need to file form IRS form 8606 in order to do that. Or if you have large personal losses that can help offset the taxable income of the conversion. Because remember, this is all filed to your personal taxes. So if you have a large loss that carried forward from either a personal investments or a business that you have that you're maybe filing as an S corp, and you have the ability to personally utilize those losses to offset income, it's definitely a good time to think about doing a Roth conversion, because all of the additional income you're claiming is going to be offset by those personal deductions and losses that you have. Now, there's a couple different kinds of conversions out there. Now, they're all going to be factored the same with regard to the amount of taxes that you pay, because it's all just a value at the end of the day. But it's important to understand that you don't have to be in a cash position in order to do a Roth conversion. If you're invested in things such as securities or real estate, or private LLCs or trusts, it's going to be what's called an InKind Roth conversion. You'll need to have a certified appraisal of the asset. You'll need to provide that to us. The asset will need to be re-registered. So if it is something like a securities holding of a private company, we'll need to get in touch with the CFO or the registrar in order to make sure that stock certificates are re-registered in the name of that IRA, because you are actually technically transferring ownership. IRAs in and of themselves are different entities from each IRA you have. So if you have a Roth IRA and a traditional IRA, they are separate entities in a legal sense. So that's why there needs to be a re-registration of any type of asset, and that can be a quitclaim deed for a property. It can be an amendment or an assignment of an operating agreement or assignment of interest in that. It can be an addendum to a trust agreement. So just keep in mind that there is some additional paperwork, especially if you're utilizing an end of the year strategy in order to spread out the liability across 2 years, that it's not just as easy as doing a cash conversion. Now, a cash conversion, Past just figuring out if it's a good fit for you to do the conversion is extremely easy. Values are converted at a dollar for dollar, and unless other circumstances exist, the conversion can typically be done without any special documentation, meaning that if you have cash in your account, all you need to do is complete our Roth conversion form, and we move the funds into a new Roth IRA, and you're done. If it's in kind, if it's of assets, other than cash, it's definitely something that we discuss with you and also discuss with your evaluator, because there might be, as in with the case of the LLC, the ability for you to take a discount, or there might be additional documentation, such as in the issue of real estate, things that need to be recorded in the public record. So which option's best for you? Again, I can't stress this enough. We can explain the rules to you, but at the end of the day, you need to check with an attorney or a CPA to determine which one's the best for you. Those are the people that are licensed to legally give you advice to this effect. We can explain what to ask and what options you may have, but at the end of the day, whether or not it is a good idea for you, that advice needs to come from your own personal endeavors or own personal advisors. It is important to understand that although it is very attractive and the Roth IRA is promoted a lot, it may not be the best idea for everyone. If you don't have a lot of deductions, or you are paying high taxes and you just want to have a Roth IRA for Roth IRA's sake, you might be paying a lot in taxes and may not be getting as much of a benefit. Roth IRAs do not allow for deductions for their contributions. So if you're someone that needs a lot of deductions, or you're trying to offset a lot of other taxable liabilities in a given year, it may be beneficial for you to wait and not do the Roth conversion at this time. It is possible to switch between strategies later, but you may need to do some additional documentation. And the taxable consideration during the investment life cycle of all the accounts is the same. So if you're just concerned with offsetting, let's say, the income, the taxes for, let's say, having a rental property, that's going to be the same between a Roth or traditional IRA. It's just really the distributions you need to be concerned with. So it's a little bit more forward thinking with these types of accounts and which strategy is best. So just keep that in mind. The present taxable exemption is the exact same for both accounts. It's going to be whether or not you'd like to pay taxes now or in the future, as to which one is going to be the best strategy for you. By converting in small increments, though, especially if you're getting towards the age of 70 and a half, you have the ability to get rid of required minimum distributions. And I see this not as often as I think would be attractive, but I really have no idea what that is. It looks like we have a question. I'm not exactly sure. Let's see, John. If I have a Roth IRA account that meets the 5-year term, can I convert the Roth IRA? If I have a Roth account that meets the 5-year term, can I convert to a Roth and distribute to avoid the 10% penalty? The aging also has to do on Roth conversions have to age for 5 years before you can convert them. So depending on how young you are, that still may be before the age of 59 and a half, you could exempt yourself from the 10% early distribution penalty, but that would really depend on your age. So you need to kind of look at that objectively. But one thing that I would like to see more of people looking at is that if you're looking to get rid of required minimum distributions, is to do small chunks of conversions up until the age of 70 and a half. So that way you can reduce by having less value in your traditional IRA, or just completely eliminate it by completely getting into an IRA. Yes, so it is possible. But if you're 47, or if you're 57 and you decide to go that route, you're still going to be past the age of no penalty anyway. So again, possible, but I would say look at it objectively from your age. All right, and I do believe that we are right up on, yeah, 12:59. So I like to make sure I respect everyone's time and get you out of here on time as well. I do appreciate everyone tuning in today. The questions were fantastic. If you'd like a copy of the slides, shoot me an email. I'm more than happy to send those out to you. If you'd like to go over any of this additional, anything additional in detail, always feel free to give me a call. I am always available to help out people. Looks like some people had raised their hands. Make sure you type in the questions. Karen, I thought I heard you say this earlier and wanted to confirm beneficiary of traditional IRA are tax-free. That is not the case. Beneficiaries of Roth IRAs are the distributions are tax-free. So if you inherit a Roth IRA, the required minimum distributions are tax-free. If you inherit a traditional IRA, the distributions are going to be taxable to the beneficiary. I have a non-spouse beneficiary IRA, but they pay taxes every year on the required distribution amount. Is that correct? Yes. In that case, if you do have withholding, that would be correct. And unfortunately, with beneficiary IRAs, you cannot convert them. So once you receive a non-spouse beneficiary IRA, it cannot be converted into a Roth IRA. You have to have that. They would have had to do that before they passed. But great question. Is this eligible for CPE? It is not an accredited course, but I can send you a certificate if you'd like, Helen. Please send me an email and I can reply back over to you with my certificate if they will accept it. All right. Looks like that we have people dropping off with no additional questions. So I'll go ahead and wrap this up here. Again, thank you very much, everyone, for joining. I really appreciate it. I enjoy teaching these classes. I hope you got some good benefit out of it. And if you need any additional clarification on anything, please feel free to call me.